Yo, 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 and welcome back to another episode of the Nyc and Griff Show. Today is Saturday, June 18th. It is 8:48 a.m. Griff, how are you doing, man? How's your Saturday morning looking?
Living the dream. I was up pretty late last night. I watched the new Adam Sandler movie on Netflix. I don't know if Adam Sandler interests you at all.
What
I don't
movie
know
is
if
it?
there's no way I'm going to remember the name. It's a Netflix movie. We just put it on, but it was good. I give it, out of all Netflix movies, like a solid, on a Netflix scale, like a 7.4 out of 10. You know what I'm saying? I mean,
Yeah.
good. And you don't expect everything from a Netflix movie, Nick, but
So yesterday we had a company float trip. We spent I don't know, maybe four or 5 hours out on the water or whatever. Ton of fun. Absolute great time. But man, the sun takes it out of you, right? So we get home yesterday. We laid down in bed at like 6 o'clock, and we were in bed, slept all night last night. But I was watching. Have you ever seen that movie on Netflix? It's about like these power pills. You twist them and you eat them, and then like you get these certain powers. And it was a pretty interesting movie. So I watched that last night. But I'll have to check out the Adam Sandler deal.
I'll have to check out yours. I haven't heard of that either, to be honest
Well,
with you.
Griff, I don't know what you're thinking here, but the markets have been something else here in the past couple of days. Let me fix the view here. There we go. Dude, I mean, let's just get right to it here. Let's look at the past week, month, 3 months. I mean, look at where we're at here. We let's see here at the 3 month back in March, 47,000. And today we are sitting at 19,124. Oof, pretty wild there, huh? S
It's
and P,
good.
S&P is still crashing here, right? S&P is crashing real hard. Look at this, man.
I just think it's good that the motto of this show is one Bitcoin is one Bitcoin, and we say that
You know
every
what?
every week. It's. I mean, like the price. Obviously, like the U.S. dollar price has an effect, or it matters. Obviously, um, I just always said the one Bitcoin is one Bitcoin deal because I'm more interested in how the network works and
Hmm.
those kinds of things than I am, I guess, the trading side of it. But
Well, and that ultimately leads us to, right, Bitcoin with a lowercase b being the coin, Bitcoin with the uppercase B being the network, right? And the investment. So that's interesting stuff, right? You think about the investment and how things are in the markets right now. There's so many other factors that play into the not the ultimately and absolutely scarce asset that the Bitcoin coin is, the lowercase b. It doesn't affect that, but it does affect the investment side of it as far as the growth of the network and the infrastructure of being able to use it, right? And dude, I mean, think about some of these things like treasuries and like uh, the Fed funds rate, and the central government setting the value of our money. I mean, these 12 guys with the Federal Reserve, they all get together and then they decide which direction humanity is going to go. I mean, that's weird stuff, man. Have you ever gotten into that stuff too much? I know that we talked about it a little bit, but what is your thought on that kind of stuff, Griff?
what, just on where the treasuries are at and where bonds are at and everything like
Yeah,
that?
I mean, well, just like what's your thought? Like, have you dug into it much? Do you know much about it, or?
I'm not a treasury or bond expert. I mean, I very much understand when they're negatively yielding against inflation, that can't be a good thing.
Yeah,
But
yeah.
on the macro, no, I'm not really too much of a bond or treasury expert. That's why I feel like we bring on guests like the one that we have on today. I feel like that's
Hmm.
why we have people we can ask questions, you know. But I
It
will
is
say
great
it
to
does
ask
have,
questions.
the price does have a network effect. I mean, ASICs and whatnot get cheaper, you know. They have like a lag time. I was listening to the CEO of Compass Mining. I don't know if everybody hates him or not. Seemed like a nice guy. And he was just talking about, when is it advantageous to be a miner? When is it advantageous to just dollar cost average into Bitcoin?
Hmm.
Um, but it does have an effect. I mean, the price of it does have an effect, obviously, because miners miners are selling, equipment is cheaper. There's better times to buy everything in life, but Bitcoin mining equipment is definitely one of them.
Yeah.
But who knows, man? I mean, everything's going down in flames, to be
right. So it's like all of these things are happening in the microeconomies and all over, our cities, our communities, even individual shops and restaurants, right? And then you got to zoom all the way back out to these larger macro things that are happening, and into trying to understand what in the hell's going on. And that's why I'm excited to have another guest on this week. A guy you've seen before here on the show, Mr. Joe Consorti himself. Joe, we are excited to have you on the show here. Good morning. How are you?
Good morning. Thanks for having me. Doing well.
Dude, the hair is looking good. The beard is looking good. You're rocking the shirt like all the way unbuttoned. I'm feeling some energy here today.
Yeah, man. It's summertime's right around the corner. White boy summer. Got to dress up for it, right?
White boy summer. Are you talking about winter? Is that a winter reference there?
No. It's just the name of the summer. Yeah. The theme of the summer, if you will.
Beautiful.
This is a different Joe than we had on the last time before.
Oh yeah.
I feel like when did we have you on last time, Joe? When we were like 3 or 4.
I think Joe's episode was the 4th episode in. Yeah, and this is number 31.
And I feel like that is kind of nuts. So what are you up to now? Are you over in Massachusetts?
I am. Yeah. So last time we talked was in January, I think January or February, and I was in Burlington, Vermont, and since then I have gone back down to Massachusetts. Yeah.
Are you a golf fan at all? I know you do the bodybuilding. I know you're not a seed oil fan, which I would like to ask you about this time around. Are you have you taken a look at the US Open at all? Because I know the US Open is out there right now, I think, right? In Massachusetts.
But yeah. So I like golfing. I golf. I hit 9 like a week ago, and I was all told like only a few above par, which is very, very good because I started playing a couple of years ago. And I'm going to the driving range like every other day, practice my drive because my short game's fine, my iron is fine, but I can't drive, frankly, for shit. And so that's mostly what I've been working on.
Golf's definitely a difficult game. It's not. In 2 years, if you're shooting a little over par through 9 holes, you're 1, really talented, and 2, it's not too bad. There's a lot of people I know that golf for like a lifetime, and they don't break 40 ever on 9 holes. I mean, seriously, it's pretty tragic. There's many people in my family. I have many an uncle that can't get it together on a golf course. But I saw the U.S. Open, and Massachusetts has beautiful courses. They're just expensive, honestly. Like if I remember,
that's Massachusetts for you. It's not just the golf courses; it's Massachusetts in general.
It's super
extremely expensive. I mean, I live in a suburb. I won't exactly say where, but our price per gallon is already like $5.30 at every single station, and it's not nearly as bad as California or some of these other places that don't have. That have worse legislating bodies, but Massachusetts is pretty bad. It's really expensive to live over here. So good thing I'm living in my parents' house, which is fantastic. Bumming off them till they kick me out. Just kidding.
No, I feel like that's a good strategy nowadays with where everything is headed. To be honest with you, average rent I think across the country is what, like 2,000 now, which is just like. I mean, that's just nuts because if you look at that from a budgeting perspective, you need to make like 71 a year for it to be 33% of your income to rent ratio, which it's just a good standard for a lot of people. I mean, like for rent not to take up like 50% of your income would be great, but I don't know. You guys come out to California, $2,000, if we're talking about average, doesn't get you a lot. Like that's all I'm going to say. It's not crazy, but I'm assuming it's the same in Massachusetts. Nick, you don't seem to be affected by those types of problems in Tulsa as much, but
I mean, so kind of it is an interesting thought. So being in this part of the country and specifically here in Tulsa, Oklahoma, there's a ton of headquartered oil and gas companies, and So the volatility, it seems, of the energy markets, it seems like they don't affect this part of the country near as much as it does other places. Now, we are still seeing gas prices go up, but my gas price going up right now is I think 49, 450 is right around where gas is for me. But that's like super cheap to you guys, you know? So I don't know.
Yeah, that's a fire sale.
It's wild. You know, it's in that, you know, to the point of all these macro things happening, right? That affect different parts of the country in different ways, that affect different asset classes, different markets differently. Joe, I know that the last time we talked, you were on a different path as you were leaving college, and now you have changed paths a little bit. I think in a very drastic way that's making you a lot happier for sure. You're doing market analytics in some sense. Tell me about what you're doing right now.
For sure, yeah. So I'm working with Nyc Bhatia. Obviously, needs no introduction, and basically, I'm working as a market analyst for the Bitcoin layer, and so I do research, all across financial markets, not just Bitcoin, but also fixed income, also equities, essentially everything. We're trying to paint a pretty broad stroke macro picture. And ultimately, I help write the newsletter to a pretty large degree. I help script out videos. And when it comes to the Bitcoin layer, I'm really trying to build that out in a pretty major way. So market research is what I'm doing now. Prior to this, I was sort of on autopilot. I was going for really more of like a salesman role. But ultimately, I enjoy doing market research. I have a more analytical mind, and I like piecing things together and explaining them in ideally simple ways. And being a salesman and really being on autopilot, ultimately wasn't the path for me. It was more so something that I just had in my back pocket while I was, studying markets on the side and posting everything that I could on Twitter. Yeah. So yeah, no, it is really my trajectory. It was my intended trajectory this entire time, but here we are.
That's exciting, man. I think that's I've always thought that was fun. I've gotten into some of that stuff where I've just read like a little bit of articles, kind of chased down some things, but I haven't done anywhere near what you're doing right now. I mean, what are some of the things, like what resources do you use? That's one thing that I'd be curious. But what resources do you use to do research in equities markets, fixed income markets, whatever it is? What resource are you using?
Yeah. So it's a lot of learning. It's a lot of listening to people smarter than you. And I suppose regardless of how much you advance or how high you go, that is ultimately the bulk of your job description. So for me, I do a lot of listening and reading of BMO Capital Markets. They put out a really, really good newsletter about fixed income. They do a really, really good podcast about fixed income. And it's very high signal, not a whole lot of noise. Granted, the two gentlemen that run it, are rather dry, but again, it's very high signal, not a lot of noise. They're not trying to fluff it up. And so I spend a lot of time, reading things like that. I also have a Bloomberg terminal, that extremely expensive $20,000 machine. I got it for free from my school because I called Bloomberg customer support and I convinced them that I was a faculty member. And so they installed it for free on my home laptop. And so I have a Bloomberg terminal that I use to peruse. That is the most live on time, sort of real time data. And so I love using that thing. And also, Nick is a great resource. He obviously used to trade fixed income. Then he wrote Layered Money. Now he's a professor at USC Marshall. And so he is a hive mind of knowledge that I've picked the brain of. And every single day working with him, I'm exponentially smarter than the last. So those are essentially, my main things. Also, there are a great deal of other things that I read and other, YouTube channels that I listen to, particularly Blockworks, Macro. I follow a lot of Alfonso on Twitter, Luke Groman, basically just trying to be the most porous sponge on the scene and soak up all the possible information that I can, because ultimately when it comes to Bitcoin, it's more of an infantile industry, but and so in terms of the markets, you could really sort of be self-directed and come up with your own conclusions from 13 years of data. But when it comes to macroeconomics, obviously, that's a tale as old as time, right? And so there's plenty of information to get after, and so I spent the majority of my time really learning macro, not so much spending time researching Bitcoin.
So I got to ask you one more question, and then I want to get into some of the things that you're learning and researching about. So obviously, people don't have the time or don't want to allocate the time to do the research that you're doing right now, right? And that is the value of the newsletter that you guys put together, right? Is don't do all the research. Let us do it, and let us help you understand this thing, right? Love that. How much time do you spend researching and learning about these topics that you're writing newsletters for and educating people about?
So it varies, but you hit the nail on the head. What we try to do at the Bitcoin layer is top tier research analysis education, right? When it comes to the amount of signal that you get, you're not gonna really beat the Bitcoin layer. We're essentially fully transparent in everything that we're doing in all of our market calls, right? And if we're wrong, we own up to it and in all these different things. And so it definitely varies, but we are trying to break it down simply. Ultimately, 4 or 5 hours, depending on the subject, researching and writing. It's difficult to quantify because I do spend a lot of my free time that I have, not on the clock and not even, paying attention to it, just listening and absorbing macro stuff. It's not necessarily, my job so much as it is like a lifestyle, which is why, this work that I'm doing now to build up the Bitcoin layer fits so well. But yeah, no, I don't necessarily know if I can quantify it. It isn't a tremendous amount of time. There isn't a lot of over analysis, just deep and robust analysis that we do.
I mean, I got to imagine because, and I think Griff needs to hop in here at some point because he's talked about this a couple times here the past couple days. But just all of these different things that are happening with sovereign debt, GDP growth and contraction, all different all over the country, all over the world, different states, different countries, right? There's just so many variables all over the place. Griff, maybe hit on a couple of those other things that you were talking about.
No, I was excited to ask you about the bond market, how you see obviously things in China with their treasury going up in flames a little bit. How could you explain that to the average person a little bit better? Why a bond market is so important, why interest rates going up 75 basis points affect that so dramatically. Just hit on some of those things because you obviously do a lot of research and you're pretty well versed in a lot of those things where it's just like people do not understand why a bond market is so important. I, preliminarily look at the bond market as a way that the petrodollar is supported or something of that manner. But obviously treasuries and bonds are like the layer one to the current monetary system. I mean, like without treasuries and bonds, United States treasuries and bonds, it would kind of go up in flames. No, like if that's not stable or you can't trust that market, like what are we going to trust kind of deal? Or how do you see things playing out in those?
Yeah, so there are a couple of things. Treasuries are base layer money, and we say treasuries broadly because across maturities they have different names. Shorter maturity to longer maturity, they're bills, notes, and bonds, right? And so just broadly referred to as treasuries, right? And so there's that, right? And they function as the base layer money. There's always going to be a demand for treasuries because people will always seek to save in dollars, and the most liquid instrument that you could use to save in dollars is treasuries. And so a lot of people, there's been this ongoing thing over the last 6, 8, 9 months about how there's a bubble in the treasury market. There's a bubble in the treasury market. There's no such thing as a bubble in the treasury market. There's always going to be demand for treasuries. Sure, it will wane and contract over time as financial conditions ease and tighten, but it's not as if treasuries are going to explode akin to other bonds like sovereign debt that isn't part of the United States, like other corporate bonds, things like that. So there isn't a treasury bubble that doesn't exist. Treasuries act as base layer money. So there's always going to be a demand for them across the world in order to save and spend in dollars. When it comes to the rates markets, essentially the reason that this matters for normal people is that these rates, these reference rates that we talk about, right? So you've got, the 2-year is a very popular reference rate, the 10-year. Fed funds, LIBOR, which is now switched to SOFR, general collateral in the repo market. All of these different reference rates essentially set other interest rates across the economy. Okay. So if you want to understand why things happen, if you want to understand why equities moved in a certain way, if you want to understand why Bitcoin moved in a certain way, you need to understand that essentially these reference rates are running the show, right? Greg Foss says that credit is the dog. Okay, equities are the tail. Everything else is the tail, right? Everything else occurs as a function of what's happening in credit, in rates markets. Okay, so the mortgage that individuals can get on their house, that's determined by a premium to a reference rate. Every single interest rate that you get essentially has a spread on top of it, and you're essentially paying for that difference, right? So as that underlying reference rate increases, mortgage rates increase, right? Consumer credit card APY increases, but most importantly, corporate borrowing costs increase, and emerging market debt gets cheaper or gets more expensive. Okay, so debt servicing levels on emerging market debts, right? Very, very fragile economies. This is not a good thing, right? Credit risk is systematic. If some of these emerging markets begin defaulting on their debt, then somebody needs to step in, like the IMF, and bail them out, right? Essentially inject them with liquidity. So that's why more expensive debt for corporate for sovereigns at a very, very high level is not good, right? It can essentially turn an entire nation insolvent if their borrowing costs increase beyond their ability to pay them. And that sort of same dynamic plays out with corporates, right? What we're seeing right now is corporate credit spreads widening. What a credit spread, both investment grade credit spreads, which are narrower than high yield credit spreads. High yield credit spreads, also known as your high yield bonds, junk bonds. Those are bonds that corporations with fickle borrowing history have to borrow in. So essentially the worst among us, they're the first dominoes to fall when credit becomes more expensive. So high yield credit spreads, which is the premium that they have to pay over the prevailing reference rate. It's over a treasury that is the exact same maturity. Those are increasing, right? So higher borrowing costs for corporates, or we call it widening rather. And also investment grade credit spreads are widening. And so corporates across the board, regardless of borrowing history, are having a harder time servicing their debt. Now, at the same time this is going on, the dollar is strengthening, right? So in percentage terms, but also nominally based on the strength of the dollar, their debts cost more. That's my dog in the background. And so it's essentially what you're seeing right now is just monetary tightening in action. So over the last 14 years, and more specifically over the last 2 years, there's been an obscene amount of monetary quantitative easing, right? So liquidity injected directly into the economy. Rates have been locked at zero. There's been an insane amount of fiscal spending, more so than during 2008. And what we're experiencing right now is the rates market adjusting upward, which is independent of any entity, right? It's a free market, other than when the Fed can step in and become a major buyer of last resort, like we've seen in Japan. And the rates markets have adjusted upward to say, all right, that's enough. Extremely easy monetary policy. We need to reel things back in. And so the rates markets have already tightened and made financial conditions tighter. The Fed has sort of lagged behind in raising Fed funds, and as a function of that, essentially this year's inflation is a function of last year's monetary policy. And so this 8.6% inflation you're seeing now is not because of, sure, it's month over month inflation, but it's a result of the monetary policy actions that were taken last year. Okay, so the Fed is literally a year late. The Treasury market knew this, and Treasuries have been selling off precipitously. Rates have been going through the roof because basically the Treasury market last year has said, they've essentially tried to rein in the horse. But inflation has really run away from the Fed. The rates market is tightening monetary conditions. And now the Fed is essentially in a race against time to normalize inflation, 6% below where it currently is. In order to do that, they're going to have to break the back of the labor market, right? The labor unemployment rate is at 3.6%. Demand destruction is how inflation goes down. The way that demand destruction is going to occur now. We were nearing a point before the Fed's tightening actions where people were being priced out of goods because they were getting too expensive. Now, because of the Fed's actions in monetary tightening and raising rates, increasing the cost for
Getting
corporate.
priced out of the housing market, all of those things as well.
Well, we'll know. So that's an inflationary dynamic. What's happening right now is the Fed's fighting it with deflationary pressure. So what I was going to get at is now people, the unemployment's going to skyrocket. Unemployment's going to go through the roof because higher servicing costs for corporates. People aren't going to pursue as many projects. Credit isn't as easily available. Layoffs occur in droves throughout the economy, and this, is sort of mutually reinforcing. And so the labor market is essentially, in my opinion, going to get destroyed, right? Not financial advice, but that's going to, basically cause people to not be able to buy the things that they need, not because they're too expensive, but because they don't have jobs. And then that will obviously drive prices down. And so entering into a recession is how the Fed is sort of going to correct course from this, this massive inflationary spiral. Yeah.
Wow. So, an interesting piece on that. You were kind of referencing your tweet from this morning. Dude, the deceptive nature of inflation is just shocking. Exactly what we were talking about there is like people just don't, it seems like it's so difficult to understand what inflation really is and how it impacts things, right? A lot of people see it as an increase in cost in products and services when it's actually the devaluing of your dollar's purchasing power, right? But then again, to the macro side, there's other factors that affect, what's happening in Russia or with Russia and Ukraine. That's obviously impacting gas prices as well, because we do produce a ton of gas that we use or oil that we use, but we still import some, right? So there's other macro factors that Griff, what do you got?
No, I just want to. I think I was almost muted. I just wanted to ask Joe. Obviously, there's a lag time to inflation. There's a lag time to all these market effects. Do you think that we've even seen, what's going on in Ukraine and Russia affect us yet, or do you think we're just getting geared up, which is why some of the interest rates are coming up at such high of a pace because they know that we're about to have a lot of supply problems, or do you think that it's all kind of getting mixed into one bag already? Because I kind of or would you argue, what do you think the inflation is now? Do you think the inflation is just them printing money for COVID relief? Do you think that's why we're getting so much inflation right now? And then obviously the war is going to play another factor here in a few months, or what do you think the lag time is on some of that stuff?
Yeah. So real quick, one thing Nick said a minute ago, I want to correct real quick. So CPI inflation is the increase in the price of goods. It's a basket of goods. Obviously, it's a manipulated basket of goods, but that's what CPI inflation is. M2 money stock inflation, or just broadly the base money supply inflation, that is that's different. And so increasing the money supply doesn't actually impact CPI in the immediate term. It impacts it about 8 to 12 months down the line. And so essentially what I said is the CPI readings that we're getting now, 8.6%, are a function of monetary and fiscal spending that occurred last year, right? So your COVID relief year, whatever the Senate, whatever the House was passing, all those, whatever sort of QE the Fed was doing last year, wherever that liquidity ended up, it ended up inflating asset prices this year. I don't think we have a whole lot more to go in terms of this inflation. I'm of the opinion that inflation is decelerating and it's peaked, and that seems to be consensus. So, we very well might get another reading above 8.6%, but chances are its velocity is slowing down, its rate of change is slowing down, and it's about to peak. There seems to be a bit of confusion. So with Russia, obviously there have been exogenous supply shocks for the last 2 years, for 2 years straight. And so, that's naturally inflationary pressure, right? Because, supply is restricted to some degree. Ceteris paribus, if demand doesn't even change, then prices increase. But demand has increased, right? Because you have extremely low unemployment. We've had credit expansion ad infinitum for the last 2 years. And so you've got increasing demand, but supply that's been very heavily constrained that is having difficulty adjusting to it, right? And so, even, there was going to come a point even without the Fed sort of doing this tightening where demand destruction would have to occur at some point, but it would have been naturally inflationary demand destruction. Now the Fed is breaking the back of the labor market, so it doesn't become extremely inflationary. Midterms are coming up, and ultimately what needs to happen is people really don't care much more, further. People don't care about the macro picture further than what the inflation rate is, and and unemployment to some degree. The Fed's dual mandate is to maintain stable prices and maintain full employment, and they're going to really, really heavily impact the latter in order to correct the former. So it's arguable that in order to amend these supply shocks, what actually needs to happen is increased access to credit in order to build out infrastructure and amend some of these things on the supply side. But we're doing the opposite. And so, there very well could be sustained high inflation for a period of time, well into this tightening cycle, or we could peak. It's really a matter of whether or not these supply, these supply constraints could and have been corrected at the current price of debt.
What's your thought on inflation compounding over time, right? So assuming it peaks here this month, or this past month at 8.6%, and then continually falls off to whatever that target rate is. Is that 2 to 3%? Is that where it's at, Joe?
So their target right now is to normalize back at 2%, and inflation is currently at 8.6 as of May. Okay,
so then assuming that they from here taper down and come back down to that target rate as far as inflation goes. That doesn't undo what has been done. That just means it's not further increasing in cost, correct?
Yeah. And you need to have deflation in order for prices to come down. So inflation can slow and normalize at 2%, but it's not as if prices are being brought back down. It's just normalizing the rate of change of prices to 2% a year, which is why it's so. You mentioned deceptive, like earlier on the call. It's extremely deceptive because basically nobody's monetarily literate at all. Nobody's financially literate at all. I frankly had no interest in finance until 2 years ago. I frankly had no interest in extreme numbers. I mean, I've never had a problem dealing with them, but personally, I think I was very reflective of the average American in that I didn't really care about how things went so long as things didn't cost too much. And because of that, I wasn't financially literate. I couldn't navigate these things as I wasn't able to navigate them as sort of better than I can now. I'm not going to say well. I'm not going to say great because I'm not necessarily where I want to be at in terms of my knowledge. But essentially, that's why this phrase of inflation being sort of this implicit default, inflation being sort of a backdoor tax on Americans. It's true because not all of us, and when I say not all of us, I mean the vast majority of us, being politely, aren't financially literate. We don't know how to hedge against situations like this. And as a function of this, people get poorer and poorer and poorer over time. But because it happens so gradually and in such an underlying way, we end up blaming the Democrats, or we end up blaming the Republicans, or we end up blaming immigrants, or we end up blaming China. And sure, to some degree, these things may or may not impact us. The way that you vote may or may not impact us. But ultimately, the Federal Reserve is to blame in the increasing of the money supply because since 1913, coming on the 100th year of the Federal Reserve in 1 year here, or 100th birthday of the Federal Reserve. It's about time we put it down in 1 year here. We've been sort of led to believe that inflation is absolutely necessary in order to maintain economic growth, in order to spur economic growth. And there are a whole bunch of schools of thought on this, right? Namely Keynesian economics, that is, the school that posits that, and modern monetary theory that really, really posits that inflation is an absolute good and it's totally necessary. And I would say the exact opposite. And I would really go so far as to say that inflation is, the opposite of necessary, right? With technological advancement, right, goods and services should be decreasing in price throughout time. And so when politicians say things like low inflation, inflation has come back down. The price of goods and services haven't come back down, right? They're never going to normalize at that 1970, 1960, 1950 price. They're just going to continue back. When they say normalize, they just mean revert to the mean, right? So, it goes up at a rate of 2% over time, goes up for 8% here, goes down, to 1% year on year here. But ultimately, it normalizes at that 2% year on year. That's what they mean.
So, it's interesting. You hit on the piece, right, where we talk about hedging against what's happening right now, right? Because ultimately, I think all three of us want a Bitcoin standard at some point in the future. That'd be great, there's a million different ways that could look, right, based on where we're at today. And it's all speculation as far as what the world could be on a Bitcoin standard, right? But until we get to that point, we do have to hedge ourselves against the current economy that we operate in. So, Joe, what do you think, or what are your thoughts on how to hedge against inflation, or more macro trends? Like, how do you view that side of things in today's economy?
For sure. So treasuries and traditionally risk-off assets like commodities, like gold, that's what you want to be holding right now. Bitcoin, although the dream is that it will one day become a risk-off asset, that's not the way that it's traded, right? A good way to measure this is take a look how it performs when volatility spikes. So volatility is a measure of market-wide uncertainty. Volatility spikes, think pre-2008 great financial crisis, think 2000.com bubble to a lesser degree, think COVID to a very high degree. And what are the assets that have a strong correlation to volatility? You want to be long volatility during de-risking, when people are trying to hedge their bets, they're trying to hedge against inflation. You want to be long volatility. The idea is that in the long run, Bitcoin will become long volatility, but right now it's short volatility, right? So as liquidity gets drained from the system, liquidity also gets drained from Bitcoin, right? Bitcoin isn't viewed as an absolute necessity safe haven asset because it's not traded that way. Yeah. Price is truth, and Bitcoin is traded very, very highly correlated to other risk assets. Actually, the article that we're working on today, that we're going to drop a little bit after the show, is I ran correlations between Bitcoin and the NASDAQ, which of course the NASDAQ is heavily tech weighted through time. And since 2017, there's been a 90% daily correlation between Bitcoin and the NASDAQ. Okay, so that is absolute reality. That's absolute truth. And you don't have an inflation hedge when the NASDAQ has its liquidity drained because you're in a de-risking event, because nobody wants to hold incredibly debt-financed companies, i.e. tech companies, during a de-risking event. You want to hold something that will hold its value through time, right? Commodities, gold, treasuries. There's always going to be demand for treasuries. Right now, they're historically oversold. I'm particularly bullish on the 10-year. Now, Bitcoin in the long run has had a few moments where it decouples from its extreme correlation to the NASDAQ, namely every single time it goes and has a parabolic advance. I did basically period correlations, right? So correlations during a very set amount of time between, and this is weekly data. You can't do daily data to run correlations between Bitcoin and the NASDAQ. NASDAQ doesn't trade on weekends, and you need to use arrays in order to run correlations. And so essentially on a weekly basis, the correlation between Bitcoin and the NASDAQ, when Bitcoin is going parabolic, flips negative. Okay, and that's ultimately what you want to see. When you're hedging a portfolio, you're looking for extremely low or perfectly negative correlations, right? Yeah. That's why the 60-40 portfolio exists. But right now, stocks and bonds are both not performing well. And so the TradFi 60-40 portfolio enjoyers are really absolutely speechless right now, because during times of extreme volatility, their bonds are supposed to be doing well and performing just enough to hedge that huge loss in equities. But right now, that's not happening. We're seeing a huge absolute decrease in confidence across the board. Bonds are getting sold off as higher and higher interest rates are being priced in actively by the rates markets. And equities are getting sold off because people are flying to cash. People are flying to safe haven assets. So in the long run, what we're going to look for in terms of Bitcoin becoming an inflation hedge is Bitcoin turning into a long volatility asset instead of a short volatility asset, which is what it is right now. there are a few periods through time, I mentioned these parabolic advances, where the correlation between Bitcoin and the NASDAQ flips negative. In order for a true decoupling to happen, you're going to want to see consistent zero or negative correlation between these two asset classes. And once you see that, then then the public will begin. And the way that this happens is people begin trading it that way, right? Over time, this is what needs to happen. But people have to trade something in order for it to happen, right? People have to begin viewing Bitcoin as a long volatility asset, as a safe haven asset. Price is truth. The only way that that's going to occur is if people start trading it that way. And one of Satoshi's quotes was, if you don't, oh gosh, what was it? It's blah, 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 blah. He said, if enough people, something about a self-fulfilling prophecy, whatever, right? And ultimately, Bitcoin turning into a safe haven store of value has to be a self-fulfilling prophecy. Okay, in order to flip into this long volatility asset, people have to start trading it that way. People say, what's the turning point? What's the turning point? What's the turning point? Well, when people understand that there's essentially, there's a gold rock, there are other commodities that you can buy. There's treasuries that you could hold. You could hold dollars, right? Which is also a good bet. As liquidity is being drained from the system, as this money vacuum is happening, your dollars become worth more. But there's also Bitcoin, which has the highest stock to flow ratio, right? And in commodities, that means through time, its value is diluted the least. And Bitcoin doesn't have the highest stock to flow ratio yet. It will in 2024, but it doesn't yet. That still belongs to gold. And once that happens, potentially, who knows? But until people start trading it that way, it won't happen.
What is the current inflation rate of Bitcoin in this halving cycle?
Yeah, so I don't know. It's 1 point something percent. Obviously, we know 6.25 Bitcoin are being minted every 10 minutes around the world, regardless of roughly every 10 minutes, right? That's the target time. But the inflation rate, I have the equation up on my computer, but I don't have the inflation rate.
Yeah. So because it's, I think it is, like you're saying, I think it is currently higher than gold is. But then in the next halving cycle with the block subsidy, as that reduces, then the inflation rate officially becomes lower than gold, and now it is actually the hardest commodity, which is interesting, right? Another thought that's kind of weird in this time, Joe, is that there is this very real world today, like Bitcoin is a risk on asset and people trade it as if it's a risk on asset, as it is, right? At this point, it seems like is what you're saying, which kind of makes sense, right? The infrastructure is not there to truly utilize Bitcoin as it needs to be or as we want it to be, right? But also in these times when price is so low, we get to buy up an absolute scarce commodity at a cheaper price than we could 3 months ago. It's like so many parts of Bitcoin are separated. It's all connected and glued together, but they're all these separate parts. Really interesting stuff that Bitcoin gets into. It's like everything.
Yeah. There's a huge informational asymmetry right now, and I just described it. The markets are trading Bitcoin like an infinitely reproducible equity, when in reality, Bitcoin is an increasingly scarce commodity until its supply is fully exhausted in 2140. So you can capitalize on that informational asymmetry, right?
Yeah.
Or you can FUD and sell your Bitcoin and then get upset once we advance parabolically again. Okay, so Bitcoin is really about to get tested.
Love it.
Yeah. So in its 14-year history, right, Bitcoin really hasn't been through a deep, prolonged recession. It was birthed out of the great financial crisis. We had 2020, which was sort of a blip on the radar, and the Fed pivoted immediately and began injecting liquidity through QE and also locking interest rates, or locking the Fed funds rate, the reference rate, at zero. Okay. There's nobody's coming to save the financial markets now. Inflation is too big of a problem at 8.6% to pivot back to QE because your Bitcoin isn't doing well, okay? Because the NASDAQ, because the S&P 500 isn't doing well. The Fed the Fed pivoting and saving financial markets right now is completely off the table until inflation is dead, okay? And we're about to see how Bitcoin actually fares during its first major prolonged recession. We talk about money printer, right? That proverbial money printer. Well, we're about to experience the proverbial money vacuum, right? What happens when money is being sucked out of the economy and your denominator, your dollar, your denominator for Bitcoin is strengthening? What happens to Bitcoin? How do people trade Bitcoin? And right now we're seeing, there's broad market contagion. Liquidity is getting drained from every single aspect of the economy. The Fed is tapering off its balance sheet. They're selling assets. So dollars are getting reabsorbed and vaporized from existence. Bitcoin lost to 25, 24, 23, 22, 21, 20. It might lose 19. It might lose 18. So far, we're seeing how Bitcoin trades during the money vacuum. And it's important to take a look at price and have price as your core underlying, this is the truth, as opposed to having a narrative that people try to ascribe onto Bitcoin when it's not actually there. It's important to look at the price and then glean what is happening based off the price. And right now, people are, this broad liquidity contagion, liquidity is getting vaporized across all areas of the economy. Bitcoin isn't safe, right? It has lower market capitalization than any of these equities. It has high correlation to equities, but two and two together, Bitcoin falls harder and faster.
Yeah.
So that's the relationship we're seeing right now. The only way that will change through time is if people start trading it that way. But if you do believe that this is informational asymmetry, which I do, then you should be selling everything that you do not need and, flipping it to cash so you can buy Bitcoin. Not financial advice.
Is that your personal strategy right now? Is you're just stacking? I know that you wrote. I read the deal that you wrote about DCAing into Bitcoin. Is that the strategy that you ultimately recommend? I know that's what Griff and I do.
Yeah. So I would ultimately, I would recommend DCAing for people who aren't very comfortable. But for myself, thousands of hours of research. I love this space a great deal, and I'm very, very confident. I have a high conviction. The macro outlook is looking very uncertain. I'm not saying this is the absolute giga bottom, but what I am saying is that I am deploying massive amounts of capital. I potentially, allegedly, supposedly am taking out a 0% interest APR credit card for 50 months to stack. Not financial advice, but as of right now, every single cyclical indicator is telling us that Bitcoin is historically undervalued and the money vacuum is on. So
what do you think it's going to take for some of these countries like Japan, for instance? What's it going to take for Japan to go, okay, backing our economy with dollars is not working out the way that we thought or the way that we were told it would. Let's try Bitcoin. Like, how long do you think until a major country comes along and goes, oh, Bitcoin is absolutely scarce? I think obviously governments might fear the network of Bitcoin, but they can't fear the money aspect. They have to like that in a sense. To have something that's absolutely scarce, something better than gold, is better for other. Like the United States is a unicorn. We're getting it both ways. Like, we're getting it pretty much however we want it. That's almost never happened even for empires previous to us. But what do you think it's going to take for another country to go, I don't know, is it going to take a depression, or is it going to take a mass or a serious recession or hyperinflation in Japan for them to go, oh, well, we only can try Bitcoin, it's the only thing left? Or is it going to be a natural progression on over? Like, what do you think how this thing's going to get adopted over the next 5 to 10 years?
Yeah, so it varies. And this is sort of the last talking point I'll give, because I have to hop over to do some work here. So I guess we'll cut it in a couple of minutes here. But what I'll say is it varies. You saw in a country like El Salvador, they had relatively low GDP growth year on year. They didn't have a tremendous tourism industry. They didn't, there were a lot of things not going for El Salvador. It certainly wasn't the destination people were looking for, on their Central American vacation, if anybody takes Central American vacations. And they adopted Bitcoin. Lo and behold, tourism's up year on year, GDP's up year on year, foreign direct investment, all these different things. And so it benefits a country from a balanced payment, not a balanced payments perspective, but it benefits them from sort of a balance sheet perspective in a way, right? so that's what El Salvador did, right? They weren't necessarily the destination of choice, and now they've sort of morphed themselves into the de facto Central American destination of choice. Cool, right? They were dollarized. They have far less liquidity in their economy than an economy like the United States, and so that's what they did. The Central African Republic, situation where, again, they didn't have control over their own currency, right? First things first, you're going to see sort of and this is sort of off the cuff here, but you're probably going to see a continuation of that trend of the most fragile countries who don't have their own reserve currency, right? Who are essentially use the currency of another nation, right? Like the Central African Republic, like El Salvador, and they're going to start being friendly in terms of a regulatory environment to Bitcoin. The broader impacts of that, I don't know, but I would really put money on that trend continuing, for the next 5-10 years, and that sort of being the catalyst for more countries to hop on board. I don't necessarily know if a G10 nation like Japan is taking a look at Bitcoin. They have much bigger problems on their hands. Their huge unlimited bid experiment with bonds across all maturities is blowing up spectacularly in their face. There's a huge sell side even with their unlimited bid. So we will see. I don't think G10 is in the cards for the next 20, maybe 30 years. But who knows? Things could accelerate harder and faster, I think.
Man, it has been an absolute pleasure to have you on again, Joe. I've got your Twitter down here below that if you guys are watching, you can see, but it is at Joe Consorti on Twitter. Is that the best place for people to reach you?
It is, yes. I frequently shit post on Twitter. I give my thoughts all the time on absolutely everything. So catch me there, and go to thebitcoinlayer.com, all one word, to catch the newsletter and the YouTube channel.
Absolutely, yeah. And I've read a couple of you guys' newsletters, and they are really great. Really love them. It's good information. It's quick and easy to read through. It makes sense as you're reading it. I like the pictures too. The pictures are great. So yeah, you guys are doing a great thing over there. I'm excited for you, man. I'm happy for the change now that you're with the Bitcoin layer. Is that what it is? Did I say that correct? It's the Bitcoin layer?
Yes.
Okay, perfect, man. Well, I'm excited to have you on again at some point in the future. Happy to have you on again today. Hope you have a great rest of your weekend, brother. I know you guys are just about to release a new piece, so go get it done, man.
Most definitely. Thank you, guys.
See you, Joe. Man, that guy's sharp, huh?
Yeah, I feel like the last time we talked to him, he was on just this totally different path, and I know you talked to him a little bit more than I do, but dude, it's always really cool to see somebody get really successful and really surrounded by just something they're passionate about. You know what I'm saying? So it's
sure.
cool to see it. And
oh yeah, he's on a different planet as far as like what he's talking about, dude. I mean, so we've talked about this going back to all of our guest episodes here over the past like 2-3 months, and re-listening to them, and then doing review episodes of like, let's go back and think about these things we talked about. And dude, I mean, this one could be like a 2-part review. I mean, there's so much jam-packed information in there, dude. That guy has done a ton of research. He knows what's going on.
Yeah, I only fully agree with you. Do you have anything left you want to throw down on this podcast today, brother?
Man, I do not. Come check us out on Twitter. Come hit us on Twitter at Nyc Griff Show. Watch on YouTube if you're not. We got video also on Spotify, and we're on all the major platforms. So whatever you like to listen on, we appreciate it, and we will see you guys next time.
Peace.
Peace.